Hello everyone. Today I will be presenting the foundational concepts from the first 3 chapters of our corporate finance course today. We will start with the basics of corporate financial management, move into understanding financial statements and cash flow, and finish with financial analysis and planning. So for chapter 1, it was introducing corporate finance. So what is corporate finance? Corporate finance is about how companies manage their money, specifically how they invest, finance, and use their finances to run their day-to-day operations. The 3 main concerns that were brought up within the chapter 1 about corporate finance were the capital budgeting, capital structure, and working capital management. The goal of financial management, typically people will say that companies aim to maximize their profit, but the true financial goal for most companies is to maximize their shareholder wealth, meaning like the values of their stock. So moving on to business organization types, there are several different types of business forms. So organization types include sole proprietorships and partnerships, which are easy to form, but they do have a limited capital and liability protection. Corporations offer limited liability and access to capital markets, but they're subject to double taxation on both profits and dividends. So I think that's definitely something worth noting. Agency problems and regulation. So when managers or agents do not necessarily act in the best interest of principals or owners, we get agency problems. So these problems create agency costs and a lot of unnecessary financial expenses, and creates lost opportunities as well. Some solutions to deal with that issue would include incentives that are tied to performance, having strong standards, regulations, and governance, and having a regulatory framework of some kind. So the key regulations that I noted for this part were the Securities Act of 1933 and 34, which regards governing securities and setting up the SEC, and the Sarbanes-Oxley Acts of 2002, which enforces strict financial reporting standards. So moving on to chapter 2, the financial statements and cash flow. So balance sheet and income statements. The balance sheet shows what a company owns and owes during like a specific point in time. So assets equal liabilities plus equity. The income statement shows performance over time, which is revenues minus expenses, which equals income. But to note, accounting income does not necessarily equal cash flow. So like depreciation reduces accounting income, but it doesn't necessarily affect actual cash, if that makes sense. So taxes and cash flow, when marketing decisions, or when making marketing decisions or financial decisions, we need to focus on the marginal tax rate, the tax on the next dollar earned. So like not the average dollar, if that makes sense. Cash flow is ultimately top tier. So to assess financial health overall, there's 3 things that we're going to look at. We're going to look at operation cash flow, so like the operating cash flow, cash from core businesses. We're going to look at capital spending, and we're going to look at cash to creditors and shareholders. The cash flow from assets must balance out with what's returned to the investors. So the statement of cash flows. This ties kind of all together, showing changes in cash across operating activities, investing activities, and financing activities. This is very, very vital for decision making and planning, more so just than creating, making, and sustaining profits. So moving on to chapter 3. So within chapter 3, we covered financial statement analysis and models. So we covered ratio and DuPont analysis, specifically in order to analyze performance. And when analyzing performance, we use a couple of different things. So we use liquidity ratios, which basically equates to, can we pay our bills? Are we able to pay our bills? There's leverage and coverage ratios, so like how much debt do we have in total? Like what is our current debt rate? Profitability ratios, are we making money? Are we making enough money? Market ratios, so like what are investors and shareholders thinking, like what are their thoughts. So the DuPont identity breaks ROE, so return on equity. So return on equity, essentially there's this equation that's very important to understand. So profit margin times asset turnover times equity multiplier. This is how to show efficiency, asset usage, and leverage of the impact returns. Moving on to financial planning models. So firms typically use pro forma statements and the percentage of sales approach in order to forecast their needs. These help to estimate the EFN, or external financing need, which is essentially how much funding is required in order to support growth. So from there, we will also begin to assess IGR, which means internal growth rate. So essentially that is growth using retained earnings only, as well as sustainable growth rate, SGR, which is growth using earnings and debt, but no new equity. So to kind of finish up and go over our final takeaways and everything, the corporate finance is about making smart investment decisions, smart financial decisions, and smart operational decisions. So it guards cash flow, not just profits, and it drives value. So the financial analysis helps to evaluate performance and plan for growth. So understanding these foundations kind of set the stage for making informed business decisions and supporting long-term valuation. So with all of that said, I think I'm just going to kind of go over the last couple of slides. So again, in chapter 1, we covered the introduction to corporate finance, which goes over capital budgeting, capital structure, and working capital management. Within this, we also covered sole proprietorships, partnerships, corporations, and how corporations are subject to double taxation. We also went over the solutions for agency costs and agency problems. We also covered some key regulations such as Securities Acts of 1933 and 34 and the Sarbanes-Oxley Acts of 2002. Within Chapter 2, we covered a couple of important things such as assets equaling liabilities plus equity. We also covered how income statements show performance over time, which is revenues minus expenses, which equals income. So, and also an important note here was that accounting income does not necessarily equal cash flow. So I thought that was an important point. So we did cover cash flow being top tier, operating cash flow, capital spending, and cash to creditors or shareholders. We kind of went over how this all ties together through the statement of cash flows with operating activities, investing activities, and financing activities. And then finally in Chapter 3, we covered the ratio and DuPont analysis. So we covered liquidity ratios, so like can we pay our bills, leverage and coverage ratios, so the amount of debt that we have, profitability ratios, are we making enough money actively, and market ratios, so like what do our shareholders and investors think. So just to kind of go over the DuPont identity again, that breaks ROE into profit margin times asset turnover times equity multiplier. So this is how efficiency, asset use, and leverage impact returns are analyzed. The last couple things that we went over were IGR, which is internal growth rate, and SGR, which is sustainable growth rate. And yeah, so I believe that covers all 3 chapters for the first part of this course. I think just understanding these foundations and how they set the stage for making those informed business decisions and help to support long-term valuation is really important. So my main key takeaways from this chapter, or 3 chapters, were corporate finance being about making smart investments, smart financial decisions, and smart operational decisions. I also noted that cash flow, not just profit, drives value. I think that's really, really important to note. And financial analysis helps to evaluate performance and plan for growth in the future. So with that said, I think I've covered all 3 chapters, and I look forward to hearing back from all of you and getting some feedback on your thoughts of the first 3 chapters as well.